Hi, it's Jamie Heiberger Harrison, live today to discuss foreign investors. I know that the market has changed a lot. It's been much more difficult for clients, sellers, and buyers to do transactions overseas just by reason of the fact that it's been so difficult to get money in these days. Even deals where I've been in contract and money's been sent over, getting that last bit has caused delays on numerous transactions. Nonetheless, transactions are happening, so I want to talk to you today to explain to you what you should do when you get a call from a foreigner that's looking to purchase and sell property here in New York. So, and actually, you know what, this will apply for the most part also to whether they're buying in New York or elsewhere. So if you're watching this anywhere in the country, this will apply to you as well. The first thing that I do as a lawyer, when a client calls me up and they are going to be purchasing in New York and they are a foreigner. Now by foreigner, I don't just mean somebody that is not from this country. I don't mean somebody that is not a citizen. What we're talking about is being a foreigner for tax purposes. In other words, you can be a foreigner, but you can still pay taxes here. And so the rules are a little bit differently based upon how you're categorized for filing your taxes. First thing that I want to know is, how are you purchasing? Are you purchasing in your own name, or are you going to be purchasing in an LLC or in a trust? There's a very big misconception here in New York. What I've noticed, well, I say New York because I practice here in New York, that people tended to believe for a long time that all you needed to do when your client was purchasing as a foreigner, form an LLC, form a trust. That gave the protections that you needed. That is not the case at all. If you have a client who's a foreigner and they're buying here in the States, the biggest pitfall that they can face is with their estate planning. Here in our country, as of January of 2018, the gift tax and estate taxes have changed. Now, there's an $11,180,000 gift tax exemption on the federal level. In New York, we're still at around $5,500,000, a little bit less than that. What that means is that if you're from the United States, when you die, your state gets certain exemptions. From New York State, you get the $5.5 million. On the federal level, call it $11,200,000. And if you're married, those numbers double because you have for each spouse. If a foreigner dies here and they own property here, they do not get those exemptions. Even with the changes in January of 2018, still, the only exemption that a foreigner will get is $60,000. Just by way of example, your client purchases a property for $10 million. God forbid something happens, they pass away, and they own the property either in their own name, in the name of an LLC, or in a trust. Doesn't matter. It still goes to them in their foreign status, and therefore what to pay approximately $4 million in estate taxes, because that's all they have is the $60,000 exemption. So you ask, well, what do we do? How do we protect that? Well, the answer is this. It's really complicated, and your clients, you might not want to do it, but if you wanted to go for that full protection, no risk, what you would do is have an entity set up, a foreign entity. That foreign entity could be set up in the Channel Islands, the BVI, Panama, it all depends. But they set up that foreign entity and you set up a domestic LLC. The foreign entity would then be the owner of the domestic LLC. Now, the one catch is this. Even though you're doing that proper structure so that you're taking the foreign status entirely out of the equation, you still then would need somebody who would sign as a manager of the domestic LLC. If you get that done, then you're covered. No worry about estate taxes. Now, the other thing we think about when we think about foreigners investing here is FRIPTA, Foreign Investment of Real Property Tax Act. And what that means is that when a foreigner sells property, there is a withholding that has to get sent to the Department of Treasury in order to protect our government from the gains tax that would be due upon the sale. So properties between the prices of $300,000 and up to $1 million, there's a 10% withholding that has to be withheld at the closing for a foreigner. Over $1 million, 15%. What does that mean? That means if somebody is selling property for $2 million, there's going to be a $350,000 withholding at the time of the sale in order to protect against gains tax. Now, a couple of options here. You can either do that withholding of 15%, send it right into the IRS immediately after the closing, and that's it. Or if the seller is not going to owe that much in gains tax, what they can do is hire an accountant here, or they can do it themselves. I don't recommend that. Hire an accountant here, have them prepare and submit what's called an application for a reduced withholding certificate. That can be done anytime. You can do it before contract, you can do it after contract. As long as it's done any time before the closing date, even one day before, and you have proof that you put in that application to the IRS, then instead of sending that, in the example of a $2 million purchase, that $350,000 to the IRS, the attorney can hold it in their escrow account. Now, if I'm a foreign buyer and I'm in this country and have no connections to this country, that foreigner is going to be way more comfortable depositing that money with their attorney rather than sending it to the IRS. So I highly recommend always apply once you are in contract. And what does it mean? You send it to the IRS, the application for the reduced withholding, a copy of your sales contract, a copy of the broker's commission, a copy of the transfer tax forms, and proof of any improvements that you put into the unit during the time of your ownership, as those two will reduce the amount of your gains. Additionally, depreciation would get accounted for, any assessments that you paid during the time of your ownership. For that reason, I also recommend that as a foreigner, you absolutely should be filing each year non-resident income tax returns. Even if nothing is owed, if you don't file those returns, you're going to have a problem when you apply to the IRS later on for that reduced. Then they also avoid FRIPTA when they sell. Now, assuming that a seller of property is not a foreigner, then under those circumstances, the buyer really doesn't have to do anything. They can just go to contract like anyone else, not do anything, and just deal with it all when they sell. However, in the event that the seller also is a foreigner, that foreign buyer should, well, they don't have to, but they should obtain what's called an individual tax ID number, whether it's for the LLC or their own name, because that foreign seller, in order to transfer to the purchaser, is going to have to comply with FRIPTA. In order to comply with FRIPTA, the buyer also needs a tax ID number. That can take anywhere from 2 weeks to 2 months. 2 weeks would mean that your buyer has an online Skype interview with the IRS in order to get that number. Alternatively, they can go through the standard channels and it may take 2 months, 3 months in order to get that done. Anyway, we're out of time. Foreign investors, I think there's a ton of information out there and a lot of great points to hear and discuss. And if you have any other questions for me, reach out anytime. Have a good day.